down the hammer and pick up the pencil. You're about to listen to the Savvy Radio Show. Learn from real-life real estate investors, experience revealed with the Savvy Landlord as your host.
Correct. If the appraisal comes in correct, I remember one time I was in a conflict with a banker, not you, another one, and this appraisal came back, and it should have came in at like $50,000. Came in at $35,000.
Which was the correct number.
Yeah, correct for the banker. And of course, I was like, Mr. Banker, I was like, buddy, you ever heard of income coming in, stream? Don't you base? And he just threw his hands up. You call the appraiser. So that conversation didn't go well with me and the appraiser guy because I was nervous, the communication with that. So did the banker back me up on that? I don't know, but today we're going to learn. Did I purchase that property? Yes. Did I bring money to closing? That's the banker's favorite words. Chumps. But anyway, I think you can't succeed in this business without bankers. Now, if you hang out with Brian Nix, he is very successful with using private money. And, it's interesting to have great conversations with him because he wants to know more about banking. He mastered private money. And I felt like I know a lot about banking. I deal with a lot of bankers. And I love the philosophy of banking and how you could deposit money and they loan it out 10 times. The philosophy of banking is just the gangster business. And I'm like, man, one day I want to be involved. I came across Evan Rink a couple of years ago through a banker. And this is one thing that you need to do. Stick with your banker. A banker told me years ago when he retired, one day I'm not going to be around. You need to build a relationship with bankers. And I didn't understand that because I was scared because I had a relationship with this banker. But then this banker left another bank, went to another bank, and then that person left, and that's how I met Evan. And he was young, and all the bankers that I meet are older, sophisticated. He's sophisticated, but he's younger. And I didn't understand how it was going to go down, but I've never met someone as so passionate about banking and analyzing property. It's almost to the point of fun to send him properties, and he analyzes them and kicks them back and busts my balls on them. And he's like, what are you doing? And he started out as a teller. So from the mailroom all the way up to managing millions and millions of dollars of portfolio at a $3 billion bank. Is that what you're...
Six now.
$6 billion. So First United Bank is an up-and-coming bank that is gobbling up little banks. And they treat... The cool thing about... I'm always scared of big banks. Over $250 million is usually the banks I don't deal with. $250 million and below are the banks that I communicate with and want to do business with, a.k.a. community banks. So... When I met you, your bank was only $1 billion.
We were two at the time.
$2 billion when I met Evan. And I was like, this relationship's not going to go well. Because usually when you get to that level, there's a lot more red tape, there's a lot more drama. There's this credit analysis person that's their job is to scare you. And I remember the meeting I had with you in this credit analysis that just flies around the country, just doing analysis on people. But I found with First United Bank, they love real estate. Their division, is there a special name for your division?
No, we're just
commercial lending?
Honestly, I have one of everything, but I specialize in...
Oh, and you do other loans?
Yep.
Okay, so he does all kinds of different types of loans, but he is passionate about real estate, and that's why he's here today. And the subjects that he's going to talk about are just things that I need to learn. But you definitely need to get to know Evan. It's an honor to have you speak today. And if you don't mind, if you put your hands together for Evan Rink.
Thanks, everybody. Kind of took the wind out of my sails on that. I don't know how I'm going to follow that up. But today we're going to talk about bank appraisals. Raise your hand if you actually read your appraisals. Well, other than the first page, obviously.
Just the first page.
To get the value.
It depends on what the first page says.
Okay, there we go. I like that.
We don't need
Exactly. Hey, and I want to be honest, there were some older bankers in my office. I'm not going to name any names, but they did the same thing. Got it back from the appraisal department. Yep, this is good enough to close. Right in the file. Where I come in is I'm a data-driven person. I want to know what that appraisal says? What information is in it? What information can you get out of it? What information can you use on your next deal? So if you're buying multiple properties that are similar to the property that you just sold, there's a lot of really good information in there. And it'll also tell you how to kind of go and find your own values. I'm going to go ahead and get into who I am. He kind of already said, started at a part-time teller, had a fraternity brother say, I was working at O'Reilly's at the time, and he was like, hey, do you want to not work holidays or weekends and get paid a little more money? I said, yeah, that sounds awesome. I was in college. I was like, yeah, absolutely. Who doesn't want more money? And, so after getting into a community bank and understanding the community banking feel and really understanding your customers and really understanding the needs and wants and kind of passion of your customer and really getting to know them on a one-to-one level. From my time as part-time teller, full-time teller, new accounts, branch manager. Once I graduated with my undergrad in finance, I moved into the accounting department. So it was me and the CFO. And then we had a whole team of bookkeepers underneath us. And we did everything from board reporting to ALCO reports to the information that we send to the FDIC. That was a lot of trial by fire and kind of understanding how banks work, where they get their money, why are interest rates set the way they are? And, is it really somebody just saying, oh yeah, 5%? No, it's a little more complicated than that, and they have sources of funding. I know people in private money, you guys have your set metrics and numbers and things like that on your cost of funds. And so banks are no different. But anyway, I moved to First United Bank, started off as a credit analyst looking at tax returns and stuff like that, doing the analysis piece of everything, and then moved into commercial lending. So I like to say that I have one of everything in my portfolio. It's primarily real estate, but I've got nursing homes, roofers, dentists. I've got 2 churches, convenience store, a little bit of everything. I've got a private jet charter company, which is one of my favorite clients to go visit. But it's been an interesting go. I've been in banking for 9 years, almost 10 years now. So again, not a stranger to the market. But anyway, so we're going to talk about bank appraisals. I'm going to start off by saying I am not a certified appraiser. And I am not a commercial real estate broker. Those are two. I have some certification in real estate appraisal. I took a class when I was going to college. I have state accreditation, but I do not have I'm not a formal MAI appraiser. Not a commercial real estate broker. I don't pretend to be. I look at a lot of real estate deals and I read a lot of appraisals. That's really where my expertise comes in. And if I have a technical question, I reach out and have conversations with those people. Like he said, it's all about networking. It's all about who you know. Get as many contacts as you can. And don't be afraid to pick up the phone and call and ask somebody. Call me. You guys are going to have my contact information. If you got a question on anything about banking, anything about what I have to say today, give me a call. I'm more than happy to talk with you guys. So, types of appraisals. So we have the Fannie Mae or complete residential appraisal. When you guys bought your primary residence, you probably got a full-blown Fannie Mae appraisal. They come on a super boring form, and they're standardized, and they have pictures of the interior and the exterior. That's important when talking about the next one, which is limited scope. But limited scope appraisals, those are the cheap ones. They do a drive-by, or it could be a desktop appraisal or some other valuation method that is more limited in scope. And I'm going to get into these as well. The thing I'm going to spend a little bit more time on is the commercial appraisals and understanding what all's in a commercial appraisal. So they have 3 approaches to determining value, which is the sales approach, which is a lot like the residential approach, which we're going to talk about. The income approach, which is the cash that's coming off the properties, because that's really where the value is driven. And you guys are kind of in an in-between, those of you that are buying residential rental property, because you guys are buying them for the income stream. So that's really the value to you. And so I'm going to get into that a little bit and kind of talk about the transition from just buying physical real estate to buying income-producing real estate. And then finally, the as complete or as stabilized, which Stephen found out there is a difference in what type of appraisal you order and everything you need. So I'm going to jump right into it. So the Fannie Mae, or the complete residential appraisal. This is required by most mortgage companies. This is, so if this is going to secondary market, they're going to need a full appraisal. That means they're going to go through and they're going to take pictures of the property, they're going to measure stuff, and they're going to basically go through this property, not with a fine-tooth comb. They're not an inspector, and they make that perfectly clear. But they're going into the property, and they're actually looking at the property, the improvements, looking at the roof and things like that from afar. Again, they're not an inspector. But typically, this is also required on bank transactions over $100,000. John, what do you require for full-blown residential appraisal versus limited scale?
We don't do owner-occupied loans out of our bank anymore.
Okay.
And so we don't even do the full-blown appraisals for those. The
Really?
appraisals that we get is for our investors would be a limited scope.
Okay.
Anything over $250,000 that we have to get a full commercial appraisal.
Full commercial. Gotcha. Perfect. And again, it's a little bit different depending on what banking institution you go to. So our bank, we've got a lot of rural community banks, and so we actually do bank side first mortgages, which they don't have a secondary market for. And so we've got a little different rules and regulations that we have to play by. But so understanding kind of what those thresholds are is going to be very important. And so I say this because appraisal is required for properties and transactions over $100,000. If I have multiple properties in that, I may not need a full-blown appraisal. However, when I talk about the limited scope, you guys may want a full-blown appraisal, and I'll talk about that here in just a sec. So like I said, it includes photos of the exterior of the property. They have strict guidelines on what comps can be used, when the sales were, how different the property is in condition, age, location, and things like that. So they actually have guidelines that it has to fit within that box in order for them to consider it a comp. And then like I said, they compare it to the subject property, and then they either discount it or based on the features that are included. Does this have a pool? Does it have a bigger lot? Does it have these other ancillary items that the subject property versus the comp properties are? So moving into the limited scope. So these typically cost between $150 and $200. Is that kind of what you're seeing? Some of you guys may know Kelly White. They do a lot of the limited scopes for us. We have several other vendors in the Oklahoma City area, but that seems to be who most people use. Most people super quick turnaround. It's been a little hit and miss when it comes to valuations, and that really has to do with the comparable properties. They're not as strict on what the property needs to look like. It's oftentimes done on a desktop. So all appraisers use a similar or same software that helps them pull all these comps. And then it's a decision on which comps to include that are most like the property based on their expertise. And so oftentimes on the exterior evaluation, that's really what it is. It's an exterior evaluation. They're not going inside to see that you've put 20 grand, 30 grand in the kitchen, or you jumped a new roof on there, or have a new HVAC system. It really is just a drive-by. So this is an instance where if you're doing a rehab, that you may consider a full-blown residential appraisal. The cost is probably double. So again, 150 compared to 325 to 525. But again, if it means doing a deal and not doing a deal, I would probably rather go with somebody who's going to walk in and see all the improvements that I've done. Again, that's just up to you. Just a recommendation. And again, I'll talk later about what happens if your appraisal comes in lower than you want.
Couple questions. What's the difference? Why is it 325 to 525?
So that ranges based on we'll send it out for bid, and then they'll send it back.
Is there better service for a 525
No,
guy?
It's based on how busy all the appraisers are. So it's a supply and demand. Seriously.
Makes sense.
If you guys want an appraisal back sooner, ask your bank. they'll probably get an appraiser to do it, but it's going to cost you. And I'll get into that when I talk about the commercial stuff. But also kind of how complicated the property is and how far that appraiser's got to drive to go get it. So if you get an appraiser out of Shawnee and he's got to drive to Yukon, he may charge a little more to go take pictures of the property and look at the comps. Or if it's complicated property. I had a property, customer of mine was building his own house on his own land, and he had a 10-acre lake on his property, and he wanted that value in his house so that he could borrow against it. So, right? So
Good luck.
yeah, exactly. So they gave him some value for that improvement, but I mean, obviously it wasn't what he wanted. But that appraisal was probably $700
Wow.
because he had a complicated property. There wasn't a lot of properties like it. There weren't properties with 10-acre lakes on it in Shawnee. So again, that's kind of why you have the range. But it's really not a huge range, 325 to 525.
No, just curious.
On the scale.
One other question is,
Yep.
have you noticed, since you've read a lot of appraisals, full-blown to limited, have you seen values be such strewed, like difference?
Yeah, specifically in the case of a flip, where, you know, if you don't include all the information for the improvements on the flip to the limited scope appraiser, they're really just kind of pulling comps that look on the outside similar, and so they don't know what all you've done to the property to improve it. They're really just driving by, taking a picture, looking at the comps in the area. They're not necessarily going to comp it out to other improved properties.
So basically, it's a lower value for a limited scope would be a rule of thumb?
Again, not necessarily. You know, they probably could be similar. It just depends on how you bought the property and the improvements that you did to it. But I wouldn't say it's a hard and fast rule of thumb on.
Okay, cool.
But I would just say I would look if you've gone in and put $50,000 in a $50,000 property, then you might want a full-blown appraisal. But if the other houses in the area are selling for $120, you know, it all depends on the comps. And I'm going to tell you on the Zillow and the ePraisal websites and things like that, they're not always gold.
They're
not gold. Don't get your value.
Damn.
Yeah. Don't.
You mean my personal house isn't going up $5,000 or $6,000?
No, yeah, exactly. It's okay.
Appreciate you, but you know,
Take what
we're done.
Take what Zillow and ePraisal says and divide, and then add the tax assessed and divide by 2.
and then
Seriously.
divided by 8.
No, seriously. If you know, would you sell your house at tax assessed?
No.
You said yeah. You are.
Yeah, I would.
You get murdered on your taxes. All right, keep going.
Exactly.
Where are we at? All right, commercial appraisals. So, cost approach. That is, how much is it going to be to rebuild this property? So, if I had to tear it down and rebuild it, how much would that cost? And then they're going to discount it for how old it is, and then functional obsolescence. What is functional obsolescence? If Steven here had a sunken floor and a disco ball, they're going to discount it because that's obviously not trendy. So,
hey, you know, we don't know his
he going through his.
This is good information.
Yeah.
All right, keep going. Yeah.
So, the next is the sales approach. So this is just like the residential side. They'll look at other properties that are sold in the area and compare them to the subject property. And that is most easily done on a per square foot basis. So they will take the sales price of the property that had recently sold, that's similar to yours, divide it and get the per square foot price, and then multiply that square foot price times the total square footage of your property in order to come up with a value. And so they'll have 4, 5, 6 comps, take an average, given a plus or minus for how closely it resembles your property, and they come up with a per square foot value and then assign that to your property. The income approach we're going to get into a little bit deeper on the next couple slides. So again, the sales approach. So let's pretend that another apartment sold down the street for $65 a foot. and you're buying your property. You take that 65 a foot, and then you'll multiply it by your total square feet and compare apples to apples, right? So if it sold for 2.2 million and your property is 1.1 million, well, is that a comp? Well, you don't know. You got to compare it apples to apples on a per square foot basis. Oftentimes apartments, they'll go by unit. So it's 52,000 a unit, and then you can compare the total number of units if they're similar size, similar age, and things like that. Hotels are by door. So each room they'll assign a value for that. Trying to think of some other weird ones. Sales per square. Sometimes they'll use sales per square foot. And then I'm going to pass out a cheat sheet for kind of all the ratios and kind of help you guys calculate kind of the price per square foot and things like that. That I like to call the banker's cheat sheet. So we'll go over that in just a minute to help talk about the sales approach. So the income approach. I don't know if you guys can all read this, but the income approach uses the historical information from the property to determine value. Okay, this is only done on commercial properties, so apartments, mini storage, retail centers, office space, kind of anything that's going to be bought and sold on the income that it generates. And that's where it's a little bit different from residential, is that commercial is all about what income is driven from the property. That's where the value is. So people that are buying properties as a value add, they're buying them because it's a low income generating property and they can easily rent it for more money with small renovations, and that value actually kicks out in the value of the property. So if you're buying a office building and it's at 50% occupancy, first, we'll call it 50% occupancy, and it's been underperforming for years, and the guy or that hadn't been taking care of it. And you can go in, spend a couple grand, and get that space leased up. It will actually come out in the value. So all of these properties are based on how efficiently they generate cash flow. And if you can increase the cash flow of the property, it is directly related to what the value of the property is. Where in residential, it is mostly related, I'll say all the way related, to the comps in the area. So while this uses comps and things like that, the number one driver of value for commercial properties is the income that it generates. That's why you're buying it. That's why you're buying these properties, is the income that's generated. So start at the top. It has your total space. So this is a small retail center. So 8,000 square feet at $22 a foot gives you total lease income of $185,000. So because this is a triple net property, they have reimbursements. So if you guys aren't familiar with the different leases that are out there are, so a standard residential lease, they don't pay the taxes and insurance. Wouldn't you guys like them to? That'd be nice, wouldn't it?
I want all my buildings triple net.
So you can actually negotiate that in to where they'll actually pay for the taxes, the insurance, and you can even provide for some common area maintenance. So if you've got to go and pay for the water, pay for the lights, pay for the sod, pay for all that stuff, there's a provision in the lease to pass that along to the tenants. And they understand that, and this is a negotiated term. Just like Stephen says, everything's negotiable. This is absolutely the case. Everything is negotiable. And there's also a spectrum of lease as well. There's gross, there's a percentage lease where you pay based on your sales. There's a gamut of lease options and lease types out there that could be an entirely other seminar. But for now, we're going to focus with the most common, which is triple net, which is a commonplace in commercial property. So then we jump down to the vacancy and collection loss. This is based on the historical occupancy of the building and the market occupancy and vacancy for this type of property. So if office buildings in Oklahoma City are at 20% vacant, they may discount that vacancy, because what happens if you lose a tenant? How long is it going to be for you to get somebody else in there?
Is there a unified source for
So there's
makes to determine that?
So there's a lot of different sources. The best one is a commercial appraisal. The second best source is Price.
Edwards?
Price. Is it Price Edwards? Price. Yes. Price Edwards, Cushman Wakefield, and there's one more. CBRE. So all the major commercial brokerages put out quarterly occupancy statistics. After this, I can pull it up on my phone. I don't have the link with me, but they basically put out quarterly information on what sales have happened, what the rent per square foot is, and what the occupancy is across Oklahoma City. And so it's market specific. I mean, it's down to, the southeast quadrant of Oklahoma City. And so it'll even break Oklahoma City up into the different spots. And it'll tell you, if a new project just came online that's going to be competing with your property for tenants, that's a factor you're going to have to take into consideration. So then coming down to the operating expenses, you obviously got to pay the real estate taxes, insurance, and common area maintenance. So these items can actually be charged back to the tenant in reimbursements, but you have to pay if it's vacant. So you're going to have to pay, if nobody's in there, you're obviously going to have to come up with the money for their share, basically. The other thing that's not charged back to them is the management fee, and oftentimes they'll include a management fee, regardless of if you're managing it yourself, because they understand that you have overhead to operate this asset. And so just because I'm over here, I'm going to be the leasing agent, I'm going to be the guy who fixes the shingles on the roof, it doesn't matter. They need to assume that you have overhead, you have expenses that you need to cover, and if the bank had to take it back, that's how much it's going to cost us to have somebody else run it. So once you come up with that income, the $170,000, that was that net number at the bottom, you'll apply a cap rate. So again, where do you get cap rates from? Cap rates are technically a super, super complicated number to come up with, and it has to do with the other investments that are out there. What are U.S. Treasuries doing? What are other commercial properties doing? What is the investor's alternative risk-free choice? So if I didn't want to have any risk and I didn't want to invest in this asset, you would obviously take a lower return. So again, it's a whole convoluted deal, but I'm going to teach you the easy way to calculate cap rates. So you take the NOI, you divide it by your cap rate, which is effectively your return. So this is I would call this a Class B retail center. So this is a pretty low cap rate. So relatively stable tenants, newer property, long leases, which is why it's generating a low return, because it's relatively, the market believes that this is a less risky property. So thus it's generating a lower return.
Hey, Evan, real quick.
Yep.
For cap rates, I'm still like 8 to 12, but what's a really solid cap rate that we need to shoot for?
So again, it's all up to you, and they vary across the board. Anywhere between, I'll say 7 to 12 is kind of the general rule of thumb. The higher the cap rate, the higher the return to you. So when we get into
And the risk.
When we get into calculating the cap rate, so we're going to do this right now. So you've got a purchase price of $2.2 million. You divide it by the income that it's generating. So if we do this math real quick, that's 7.75. If you bought this asset at $1.2 million and it was kicking off that same $170,000, you're talking about a higher cap rate,
14.
a higher return.
It'll be double.
It would be double.
14.
Yes.
Do you see high cap rates like that?
On
Not on a strip center like this or whatever.
No, not on a strip center. Maybe a smaller property.
Class C.
Class C. A Class C property that has a good tenant in there. 14's really high. Nursing homes have really high cap rates. So asset to income, what they're generating, those are often traded at a 12 cap. So
Now, you mentioned trading like stocks, right?
yeah, when I say trading, that is my term for how these things are sold. So you can calculate cap rates on other properties that are sold to help figure out a cap rate for your property. So just like the sales approach on the per square foot basis, you want to know what other properties, so let's call it a retail center. What are other retail centers that look like mine trading at on a cap rate basis? Am I getting a good deal? Am I getting an okay deal? Or am I not getting a deal at all? You know, that shopping center over there sold at an 8 cap. Why am I paying a 7 cap? That's kind of the equalizer. So calling things on a per square foot basis or on a cap rate, it normalizes. It allows you to compare two properties.
And that's for the appraisal approach.
Mm-hmm.
Okay.
Yep.
Not only for your only.
No,
for yourself,
yeah. So yourself as well.
As far as how that, and maybe you're getting to this, how that translates to lendable value.
Yep.
The cap rate.
So the cap rate will vary widely. So again, if it's a 14 cap versus a 7 cap, you're talking about the value of the property being cut in half. So that relationship of income to cap rate to value, that value is where the banks are determining their lendable money. They're determining the amount that they're willing to lend on a property based on an appraisal, based on the income that it generates. And so that it kind of connects everything together in value.
I guess my question, it's easy to price per square foot from the sales approach to translate to it's worth whatever.
Right.
But how does cap rate relate to the value?
So
Or does it? Is it just a piece of the puzzle?
I will say on commercial property, it is a major piece of the puzzle. So commercial appraisals will take the cost approach, the sales approach, which we just talked about, and the income approach, and they'll weight them together to come up with a final as-is value. So they'll take all of these things into consideration when determining that value. So a lot of times what I see is that the income approach, the income approach on this property was $2.2 million. The cost approach was 1.6, and the sales approach was 1.9. The final
Say it again.
2.2 for the income approach, 1.9 on the sales approach, 1.6 on the cost approach. The appraisal came in at 2.1, so it was closer to the income approach.
So do you average all those three out?
So the appraiser will weight all of those approaches to determine the final as-is value.
So can you order an appraisal just based on cost?
No, they take in
All three? On a
three.
commercial?
On a commercial. I've also had a commercial appraisal come in at land value minus demolition. The property was actually worth more if the guy bulldozed the building.
Is there a combination of where they'll do a limited scope and factor in the income?
I've gotten a limited scope this year on a small retail building. They needed like a $100,000 line of credit. This was kind of an owner-occupied deal, and I got a limited scope. And that actually I was pleasantly surprised to see that it did include a factor of income approach to it, but it was primarily driven on sales costs.
Lower end.
It came in. I think the appraiser solved for X. They knew what I needed to get, so I'm going to get into that as well. $100. You know, if your appraisal comes in at $100 over contract price,
That's normal. Just keep on going, buddy.
Chairman,
yes.
sometimes you see like commercial listings, and they'll say in there, the cap rate on this property is 10, or, obviously that's probably, you should take that for granted.
So,
based on a pro forma type
perform.
analysis or something.
So I'm going to give you this banker cheat sheet that'll help you calculate. So if you know the sales price and the income, I'll help you calculate the cap rate. If you only know the cap rate and the sales price, I'll help you calculate the income. So if you have 2 pieces of the puzzle, I'll help you get to the third based on these ratios over here. So again, a lot of times you'll see on commercial appraisals, they'll say, there's a 10 cap property, we want $1.2 million. So just based on that information, I can tell you what income they are saying that generates. But again, yes, oftentimes it's based on a pro forma, and on a commercial property, you really want to see the actual historical.
Yeah, do you guys consider pro formas? Because those are just fake numbers in my world.
No, we'll look at them, and just like an appraiser, we'll weight the historical heavier than the pro forma. But if it's within reason and you have explanations on why you think the taxes are going to be half of what they were previously, and the insurance is going to be half of what you say. And
when I've seen pro formas, it was on a car wash, and it was just ridiculously lies.
Yeah.
But they were trying to sell it for this amount, and they were trying to back up the sale.
Yeah.
And since that day forward, I every time I get a pro forma, I just say,
you got to ask for the historicals. Yeah, you have to, and oftentimes they'll provide it, and oftentimes if it's pie in the sky, you'll walk away from it. So really understand the difference between historical and then the pro forma, and find out if that pro forma is attainable or is that blue sky. I mean, if you can't find an insurer on the planet to get you the rate that they're saying, then you just walk away from it. Or you factor that into your buying decision. You come up with your own NOI, apply a reasonable cap rate, and come back with your own value, with your own asking price, and you can justify it because it's based on real numbers and real information.
Awesome.
Because that's how commercial properties are traded based on the income that they're generating.
One more question. I've heard the term highest and best use.
Yes.
How does that factor into
Highest and best use, the perfect example was the guy that I got the appraisal back, and it was tear it down. So highest and best use, they'll look at a property and its permissible use from a zoning standpoint and a geographic location. Obviously, you don't want a car wash where there are no houses, so that's obviously probably not the best use. You don't want a mini storage in the middle of downtown. That's probably not the highest and best use. Obviously, you can't put a liquor store next to a school, so that's obviously not the highest and best use for the property. So the appraiser will look at what the building is and determine whether this is the highest and best use or whether there's another alternative that is feasible. But oftentimes it comes in the form of, this is a really crappy building, they need to tear it down and put a Starbucks here, which is the case where I was looking. So, as complete, as stabilized, this kind of goes into the pro forma as well. So if you're getting an appraisal, and this is done on the residential side as well, if you're getting an appraisal that includes the rehab costs, so I'm going to buy a property, I'm going to have rehab costs, I'm going to have increased rents. Banker wants to know that. I need to have all that information up front to give to the appraiser so that he can determine an as complete, which is, okay, I'm done with the property. I have not received the increased rents yet. And then the as stabilized. How long is it going to take me to get those increased rents? And there's a difference between the as is, which is I'm buying the property, the as complete, I've completed construction, and the as stabilized. So between those values is where the bank will use to determine what the lendable money is. So we want to know if at the as is, does that support the purchase price of your property? The as complete and as stabilized, I need to know that the improvements that you're doing to the property are going to result in an increase in rents. And they're going to look at market rents. So if you say, all right, I'm buying this building, it currently has tenants in there, it's an office building, so they're paying $9 a foot. I'm going to go in and I'm going to rehab this building, and I'm going to increase rents to $25 a foot, and it's going to be worth $1 billion. That's obviously not going to happen. They're going to take what the market rates are for the improved property. So what are you doing to the property? How are you going to improve the property? How are you going to market the property in order to get these increased rents, which will result in an increased value of the property? Does anybody have any questions on that? So residential is the same way.
So how do you get from that $9 that's current, but the seller is just older,
Yep.
not paying attention,
Yep.
lazy.
Yep.
And you do comps around, you find out that it's going for 12.
Yep.
But the performance says it's worth 15. I've seen that.
Yeah.
So the bank just goes between the 9 and the 12 and averages that, even though this seller is not, he's not hip. He's just something wrong with him.
Yep. We understand that by you taking over the property, actively marketing the property, and the comps in the area, the rental comps in the area support the $12, that's all going to be in the appraisal. But a good banker will look at that. If you hand him a pro forma and it says 22, and I know that office rents are 12, then I'm probably going to, I don't think so. Or help me understand why you think it's going to be 22 when the market says 12 and this guy's getting 9.
Now, as an investor, I'm going to keep going with as I'm negotiating with that seller and keeping it at 9
Correct.
and get the lowest value.
Right.
But then when I'm looking for money,
Correct.
I'm going to push it to the 12 or
Yeah.
13,
Yeah.
the dollar.
Again, as long as you support these observations with data and facts,
And that's commercial in
and a
general.
reason, then you can help us get there. But again, we're still going to need an appraisal to support the conversations that you and I are having.
Are you implying that you could over improve a property to where you're really not getting return on for what the
Oh, yeah.
appraisal support?
Absolutely. Call the credit card.
I saw a property in the Plaza District that was not as close to the Plaza District as they thought it was, and they bought it for $150 a foot, put another $150 a foot in it, and could not get the rents to generate what they thought. So
Wow.
again, it is possible. Yeah,
Let's put a cot out.
yeah.
More rent.
Yeah, break it into multiple
Just
rooms.
A boarding something.
Yeah,
A doghouse.
yeah,
You get more money with a dog.
seriously. So, with that being said, you can over improve the property.
Good stuff.
So, my property is worth way more than that. Hear this all the time. You get the appraisal back, and you say, Evan, this is wrong. This is absolutely wrong. This is garbage. This guy is out of his mind.
Fire that mother.
Fire that guy. Take him off
What's
the
his name?
approved appraiser list.
This is true.
And I have taken appraisers off the appraisal list. I have had appraisers come in, and I've taken them off because it is just wildly wrong.
The rookies.
One guy, I think he was getting a little senile.
Okay.
And then his daughter was trying to take over, and it wasn't a good deal. And so anyway, we've taken appraisers off the list. We put new ones on all the time. We review their work. So I have an internal appraisal department that goes and solicits the bid for me. I have no idea who's receiving the bids. They'll come back to me and say, Evan, you have this guy that'll do it in 3 weeks, and it'll cost you $500. Or you'll have a guy in 4 weeks, and it'll cost you $200. And so I'll go to you as, say, hey, Mr. Borrower, what do you want? Can you wait a little longer, pay a little less money? Yeah, sure. Or, no, man, I have to close on this yesterday. We're going to go ahead and go with the quicker one. And also, if you have a timeline for closing, let the banker know. If you have a contract date, let the banker know. That way we can get an appraisal and title work and an approval back in time. So, back to my appraisal came in wrong. Something is only worth what someone else is willing to pay. That is my 100% truth. I think appraisals are an estimate. Appraisals are their best guess. Something is only worth what someone else is willing to pay. I have this pen. Will you give me $100 for it? No. Okay, do I think it's worth $100? Sure. But something is only actually worth what someone else is willing to pay. So keep that in mind when you're wearing out bankers and appraisers on what the value is. I bought the property at $60,000, but I think this is a deal and it's worth $70,000. Well, if it was worth $70,000, then someone else would have bought it at $70,000 if it's on the open market. So again, keep that in mind and take that with a grain of salt on what you think a property's worth. It's all an opinion until it actually sells. So my appraisal came in at $100 more than contract price. That wears me out more than anything in the world.
Yeah, please tell us.
As a banker, as an investor, I would probably lose my mind. I can't tell you how many times this happens, and I believe it's a tragedy for the industry, and it lessens the values that the validity of their values. It sucks, but that's kind of where we're at. They know what the contract price is, or they see what the listing price is, and they find the comps to support that asking price and listing price. Unfortunately, we're in a digital age. They have access to all of this information. There's really nothing we can do. And I think a lot of this came down in 2006 and 2007 when these appraisers had to go to court and support these valuations. So bank takes a property back, we foreclose it, we don't get all the money that we think, we bring the appraiser in and we say, appraiser, why did you come up with this value? And they said, well, so they're less
aggressive.
They're less, I'm not going to say the word aggressive, but they're definitely erring on the side of caution when it comes to their values. They don't want to completely overvalue a property or completely undervalue a property, which, from my standpoint, hurts the entire industry.
Have you seen like a percentage like of conservative? Like is it
Of how many that come back at $100 more than appraisal? That's a great. I can go back to my appraisal department and ask them and find out what the variance of contract price to appraised value is. We have all that data, and I'm going to get to a little bit of the data that we have on commercial appraisals, but it sucks. But make sure you read the appraisals. Check the math. Check the comps. Bankers make mistakes. We don't add something up right.
You talked about going to court with appraisers or whatever. I mean, are they held accountable for their expert opinions?
They are. So in their they have accreditation, which they can lose. They also have insurance as well, professional license insurance that, in certain circumstances, can pay out on negligence.
How do you deal with, and how do you have that conversation with, most of the people I know in here are really good at negotiating.
Yeah.
And our biggest challenge is we're too good at we negotiate a great, and that really isn't reflective of the value, that's reflective of the need of the seller to get rid of the property today.
Correct.
And so it has no real bearing on
And marketing.
we're held to that. We're held to that as what'd you do to improve it? Well, nothing. I just answered my phone that day. So
the
$20,000 a month on advertising.
So the appraisal, it'll read in there. If you read through an appraisal, it'll say something to the effect of, this value is based on a motivated buyer and seller. And there's a timeliness to that and a marketing time to that. So this assumes that this property is on the open market and everyone has free access to it. So a lot of the properties that you guys are buying aren't on the open market. You guys are going and negotiating directly with the owners. There's no brokers, there's no anything. It's you scoring a deal on a property. Oftentimes these aren't included in the value. And oftentimes, and banks are starting to get more conservative to that. On larger transactions, we go by the lesser of loan to value or loan to cost. So if you buy a property for $500 and the appraisal comes in at $600, I'm going with $500 because that's what the property actually costs. And something's only worth what someone else is willing to pay for it. So bankers want to know that there's cash in the deal, cash in the property, that you have some equity in the project. And again, there's creative ways to get around that and collateralizing with other assets, and there's ways to do no money down deals or mezzanine financing. That's a whole nother side part. Mezzanine private equity to help support the bank loan. But that's a whole nother conversation. But to answer your question, on larger transactions, it's the lesser of loan to value, loan to cost. And we need to know what those what the purchase price is. And that's why I want to know what rehab, if any, are you doing to it. And I'm going to take the loan to cost and based on the total project. So I want to know what your closing costs are. I want to know what your a new roof's going to cost you, what your cost to get this new property done is. And I'm going to take the value of that. So again, if you buy the appraisal comes in at $600, you're going to buy it for $500, but you know that it's going to cost you $50,000 to get this property up and leased or whatever. Let me know that amount, and we can go based on the $550, not the appraisal $600.
Is there a term for that?
What?
From the $500 to $600 to the $550?
Yeah. So that again comes down to the as complete as stabilized.
Okay.
I need to know what the all-in project costs are.
Okay.
What it's going to cost you. You're going to buy it, you're going to flip it, or you're going to have a rehab to it. There's a rehab component. I want to know what the total project costs are. Your out-of-pocket costs. It's basically like coming in and saying, okay, you give me the purchase price, I'll do the rehab. Well, I want to make sure that that your money's in first. I don't want to be the money that comes in last. So your down payment is going in on the front end. That way, if you don't do the rehab, the bank's not out any money.
Sure, why would you ever have a risk?
Right. No one's ever come to me and gotten a construction loan and not completed the house.
Yeah, oh yeah. All right, keep going.
Okay.
Come on.
Appraisal timing, like I said earlier, appraisals take time. This is the business days for a appraisal. Builder finance, that's new construction, residential. Residential is existing residential. That right now takes 12 days. And this is against our $6 billion bank's entire process. This is what the averages are. And these are business days, not actual days. So don't call me on day 12 and say, where's my appraisal? Commercial takes longer. It takes 5 days more. Business days. That's an extra week. So be mindful of this timing when you're scheduling your closings. If you schedule a 25-day close on a commercial property, I'll probably lose my mind.
Good advice.
Okay. Why do we even need appraisals? Well, because we have to. We have to. Regulators say we have to. Private money lenders and things like that can get away with not needing appraisals if they can understand the value and understand what you're doing in the property. They can sometimes get away with something different. But banks, by regulation, because we're loaning your grandma's money, we have to have appraisals. We have to know what the values are. Again, read your appraisals. There's a lot of really good information in there. A lot of good information, especially if you're buying multiple properties in the same area. You'll need to understand what the comps are. Go out to the county assessor's site. Don't look at the tax assessed value, but look at the comps. You can click on subdivision sales and see what sales have taken place and when they did and what they sold for. Those are going to be your best source of comps. Again, Zillow, ePraisal, they'll also list the comps. So go look at those. Don't necessarily just go based on the value, but look at that information. And I've got a handout here. So while I'm handing this out, this is a banker cheat sheet on math. This has, hold on, I need one. So does anybody have any questions while we're getting this passed out? Any other additional questions? Yes.
How is the price based on the commercial? Does it just go to bid?
Yeah, so it goes to bid, and it really depends on what kind of property it is.
So like a 2.2 million will be maybe thousands or something?
Oh yeah, I think that appraisal was $2,300.
Okay, so kind of a little bit of a percentage of value.
And then how complicated it is.
Yeah.
I had a nursing home appraisal that was $5,300. So if it was a construction project with or a retail center that you're buying and adding square footage and constructing and getting new tenants in, that's a more complicated, complex appraisal. That's going to cost you. And also, I'm going to go ahead and say the biggest part of it is the timing. If you can wait a little longer, if you've got 45, 60 days to close, and you put it out to bid, and they can just do it at their leisure, you're going to get a lower price. If you need it yesterday, it's going to cost you. So I had an appraisal guy was a retail center, he had to close in 20 days.
Yeah.
He called me and said, is this possible? I called my appraisal group and said, can you find me an appraiser to get this done? They said, yeah, it's going to cost double what a regular appraisal was going to cost. So now that you have the cheat sheet, this kind of just goes down and breaks out kind of those ratios and information that we talked about. Some people call it EBITDA. Some people call it NOI. And in these scenarios, they're synonymous. It's basically what cash do you have to pay the debt service? How much money do you have before you make the loan payment? Is really what we're trying to figure out when we say EBITDA or NOI. So it's net income plus depreciation plus interest to get you that number before you make your debt payment. The debt coverage ratio, which is the banker's favorite, is EBITDA or NOI divided by the payments. How many times does my income cover my loan payments? 1.5 is good. 1 or less is bad. That means you're not covering at all. That means you're not making enough money to make your debt payments, which is very, very bad. So now we get into that cap rate calculations. So the next 3 are cap rate calculations. If you have one, if you have 2, you can calculate the other. So if you need to find what the cap rate is, it's EBITDA divided by purchase price. If you want to know what the purchase price is, you can take the EBITDA divided by cap rate. So again, if you're looking at a property, you know how much income it's generating, and you have your own personal cap rate or personal return. Say, Steve Van Koenberg only buys 9 caps or higher. He'll go and take the NOI divided by the cap rate, and that'll be his purchase price. And then you can kind of check that to see, okay, what is the asking price too? Can I negotiate them down so I can generate my internal return that I need to get on a property? Then EBITDA, you can get the purchase price multiplied by the cap rate. Then the price per square foot is obviously the price per square foot. Take the purchase price divided by the total square feet. That allows you to compare property to property, apples to apples, on a per square foot basis. And then I broke down commercial rent is annual rent divided by square feet. Residential is monthly rent per square foot. So on a commercial property, depending on what kind of property it is, rates are going to be between $10 to $25. Again, if it's office, it's going to be different than retail. It's going to be different than mini storage. It's going to be different than all of these other, all those types of properties condition factor into what the market thinks the rent is. Residential, what are you guys getting on per foot per month? Monthly rent per month, $1 a foot a month on a nice property, 50 cents a foot.
Like, I don't even do it that way.
How do you guys calculate it?
I don't know. That's a good idea way to calculate it. Does anybody calculate that way per square footage?
One of my best properties is about $1.20 a square foot.
That's
per
good.
month. But on average properties, I'm probably about 85 cents a square foot.
Okay.
I would take 50. I mean, if you're in the hood, I'd say 50 cents.
Yeah.
To 20 cents.
Yeah. And again, it depends on the size of the property as well.
Yeah. Well, I mean, I was just running some properties that I have 3,000 square foot. I get 1,500, so that's 50 cents.
Mm-hmm.
An 800 square foot place, you know, roughly about 80 cents a square.
Yep.
So
yeah,
I would use that as a matrix, FYI. Like, it'll be interesting to know because I know when I do rent rolls, it pops it out that way.
Yeah.
It's interesting.
So how do you guys? So one of my last questions to you guys is, how do you all value your properties? Okay, so bank has an idea, appraisers have an idea, but you guys are the ones that are buying these things. How do you guys value the properties that you're purchasing?
For me, it's income. That's how I value all my properties. That's the first stage of, and then I go have a whole matrix from there. But if it can't 1%, if it can't, if it costs me $80,000 and I gotta have 800, that's dumb in my world. So it's got to be depends on. I have different metrics. As if it's like a $30,000 house, it fits into this. If it's a $50,000 house, it fits into this. If it's an $80,000, it fits into this. But overall, before I even function, it's income, and then it goes into structure, and then it goes into a bunch of other scenarios. That's just how I do it. How does anybody else do it?
What you can sell it for if you have to sell it.
Okay.
So exit strategy.
Yep.
For him.
Mine is based off of income return. So I use the 2% rule. So depending on which one I know, if I know what the rent is going to be, I'll divide that by 0.02. Or if I know, what my total cost is going to be, I'll times that by 2%.
Okay.
So you're trying to buy a $40,000 house, renting it out for $800.
Yeah.
I would buy 1,000 of those. Like all day, every day, because that fits into your banking. That matrix is an easy one because that fits into your cost of goods.
And
management.
You can do that in your head.
It's an easy calculation.
That's a good one.
I typically have to have 1.5, usually. That's just 2% is like a home run in my world.
Yeah, it's hard to get. That's a slam dunk. You're never gonna. It's hard to get in a lot of areas.
That's just how I do it. But
well, it depends on the part of town you're buying it.
Right. Structure.
Some it's one, some you have to have 3.
Mm-hmm.
Oh, you're talking about the east side? Well, why'd you classify that? I'm just teasing. Anyone else? How you evaluate property? Marlon, you flip houses. How do you evaluate? Is it trendy? Is it location? What's your vibe?
Well, for me, it's been location lately.
So the plaza at $300 a square. That's your motivation.
Well, no, just areas that appeal to a lot of people.
Okay.
Like a specific demographic? Is it
like a feel?
But I mean, are you going after baby boomers or is it trendy?
Yeah, mainly.
So hipsters per se?
Not necessarily, but.
So you're trying to say feeling, right? Is that what you said?
Yeah, you feel it's that gut. I mean,
sure.
Each investment is going to be your guys' gut. It's going to be, but bankers and appraisers and everybody need to know the numbers. So it helps if you guys know the numbers too. So again, use your banker cheat sheet. Run some numbers on your own properties. Try to understand. Maybe you take your entire portfolio and see what cap rate it's generating. Or you can value your entire portfolio kind of based on that way. So again, look at sales comps, read your appraisals, and
it's awesome.
That's all
Put your hands together for Evan Brink. Hold on to the weather.
Yeah.
All right. Any key things you learned? I wrote down a lot of stuff. Highest and best use. I learned. Do you know what CAM was? Because he said CAM. Common area maintenance. You need to know that. Triple net lease. That's the ultimate win for everybody.
Yep. Make them pay your taxes.
Lower.
And insurance.
Yeah. That's the dream. When you get to the next level, that's your dream. Another thing, lower cap rate is usually safer, but you really need to figure out how to do your cap rate. One question I was going to ask him: how do you classify a property? A, B, C.
So appraisals will classify it for you, but it's pretty subjective.
It's interpretation. Mm-hmm. Any other questions, comments? What'd you learn, Andy?
I had a question about the NOI, just how you come to the net income, like what you take into account for that, because I might calculate it differently. I'm just curious.
So
as a banker.
It is net income, adding back depreciation and interest. Amortization is getting back to the NOI. But again, like we talked about, there is a pro forma component to it. If you can improve the property and you can improve the expenses, say this guy's paying his uncle out of the back and he has it in there as contract labor and you know that you're not going to have that expense, I need to know about that.
Well, just an example, let's say my income for the year on property, let's say it's $10,000, and that's my gross.
Yep.
And let's say my expenses are $3,000. So a simple net would be $7,000.
Yep.
Is that what you would do? If you just look at my tax return and say I've got $3,000 in expenses? Because I would calculate it differently based on vacancy and management fees and other things. But
so I would calculate your net based on your net income, adding back depreciation and interest. So on your tax returns, it'll have a line for interest
It's
and it'll
the
have a line
fastest
for
and quickest way.
depreciation.
Quick question. You mentioned functional obsolescence.
Obsolescence.
Obsolescence. It's too early for that. Some of the older houses I look at, they have add-ons to where you have to go through a bedroom to get to another bedroom.
Yep.
Have you seen any appraisals being affected by that or that square footage being disallowed?
So on residential appraisals, I have not, but on a commercial appraisal, I would. So an instance would be if you don't have the correct parking for the property. So a lot of older shopping centers had these kind of multi-building situations, which is only now conducive for office buildings. So you're limiting your potential buyer. I think it does take into consideration on your value as an unimproved property or that will need rehab. You're not going to get a flip house price. They're not going to compare a flip house to your house that has a weird configuration. But I have not seen where they just totally marked out that square footage, but I just don't think you're going to get as high of a per foot price.
Another thing I saw on a property just recently where the county says it's 12,000 square foot, but it's only 11,000 rentable space of income. And so that affected the appraisal. So you're thinking as an investor, hey, it's 12,000 square foot. I'm comparing it to the building next door on the county assessor, 12,000 square foot yield this, $60 a square, let's say. But then when you get a full-blown appraisal, I don't know which one, sales, income, or cost approach, it's based on income, I would assume, and it was only based on 11,000 square foot, which skews all your numbers. That's 10% off because it's usable space because it had weird hallways. And does that make sense? And so in the commercial world, it just gets a little bit different. Anybody else has any questions, comments?
I'll comment on that. I had another mentor that told me that, especially if you're doing like a flip that kind of has a little bit, an add-on that is a little bit weird space, to take the price per square foot in half. So if it's worth $100 a square foot, well, just add $50 a square foot for that add-on. But I mean, if they did a good job with it, it's functional, they blew it out, did a killer bathroom or something, you might be able to get that same square foot.
And I've done that before on converted garages in a non-conforming area.
Yeah.
Well, I appreciate you guys coming. If you have any questions, we got the landlord lunch coming up. We got the Whiz Kids event in January. You guys need to come to that. Have a great Christmas. Make sure you give charitable.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at savvyradioshow.com. Connect on Twitter @LandlordBook and always be buying assets.